Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you cash surrender value of life insurance, and explain what are the components of cash value, how someone can leverage that as a type of savings benefit or some tax-free benefits while they try to accumulate that cash value, the cash surrender value, and then what are also some of the problems and how to come up with some solutions regarding cash value maximization. So, with cash value, and I've explained this in other videos, but essentially what happens is when somebody has a permanent policy, the most important aspect is death benefit. And this is how a typical permanent life insurance policy works is we have the death benefit need is correlates exactly to saying if someone's looking for permanent life insurance, well, they understand if they're placing their dollars into that plan, then and they pass away in a year, well, then it's going to get paid out. If they pass away in 100 years, well, then it's still going to get paid out. So you have that permanent death benefit coverage as opposed to term life insurance, which is you're only setting up for a term duration of time, like a 20-year time frame. If you pass away in year 22, well, then you don't have the coverage. But if you passed away year 19, well, you did have the coverage and that gets paid out. So it's the difference between renting and owning your insurance. So with these types of permanent death benefit plans, there has to be premium dollars that are paid into this plan, and kind of think of this egg shape as how the proceeds of a life insurance policy works, or how the premium payments of a life insurance policy works. The death benefit has to get paid off through something known as cost of insurance and other expenses. So if we're looking at a type of policy, we understand this death benefit. If somebody has $1 million death benefit, well, then their cost of insurance and all their expenses is going to be much larger than if somebody had a $500,000 death benefit. And the reason being is because you have something known as net amount at risk, which says the risk that's placed upon the insurance company that's going to be providing this type of death benefit. If someone's placing, $500 a month into a plan, well, if you were placing $500 into a death benefit plan with only $500,000 death benefit, well, then you have less dollars going into the cost of insurance as opposed to a $500 a month plan going into $1 million death benefit plan. So therefore, you have more to the cost of insurance and more towards those expenses. Now, everything that is not paid towards those costs of insurance and towards those expenses go into a secondary account known as cash value, hence the cash surrender value of life insurance. So this is kind of like a savings account that is going to be used that someone could essentially pull from to make sure that that policy is going to stay in force, or they could set this plan up so that if you could think of this egg shape, we're making sure that the cost of insurance and all those expenses are small as possible, and then you have the largest amount of cash value that will provide you the savings components such as tax-free growth into that account, tax-free income that you could pull from that account, and then also the death benefit with life insurance is currently tax-free to all beneficiaries. So there are certain benefits that someone could leverage for cash surrender value, and this is something that's been more and more attractive, especially with how the tax rates are and how taxes are with types of retirement accounts, and understanding that tax brackets will most likely be going up in the future, and therefore individuals are looking for ways on how to supplement their retirement dollars later on, whether that's in a 10-year goal or a 15-year goal or 20-year goal, whatever the case may be. So there's large savings benefits with this cash value, but you're just going to have to understand the basics on how a cash value policy works, what are their ways on how you accentuate that cash value so that you're not falling victim to the problems with cash value. Let me clear off this. Anytime that I'm dealing with a client, I always try to focus in on exactly what their goals are. We know what exactly they're looking for to leverage a life insurance plan, whether that's a cash value maximization plan or they're looking for a max death benefit plan. What exactly are those goals? Are they looking to have some sort of cash value in their account, or are they looking primarily for that max out death benefit? So if you're looking for that max out death benefit, first off, there's a type of plan that does not correlate specifically to max cash value that allows you to throw a lot more dollars and have a much larger death benefit than how a typical like whole life insurance policy or an IUL policy works with that cash value component with it. And what I'm trying to explain is cash value comes with a cost. What you're doing is you're overpaying for your insurance, and whatever's left over is now going into that cash value savings component each and every month, each and every year. And then on top of it, this also gets credited by a specific type of interest credit based upon which policy you chose. So like a whole life insurance plan is gives you a fixed interest rate known as a dividend rate. An index universal life insurance plan gives you an interest rate based upon an upward stock market index, and then a 0% rate of return whenever the market goes down. So these are the two major ways on how someone could utilize those cash value accumulation plans, or the cash value accumulation goal. But if someone's looking mainly for a maxed out death benefit, and they say, oh well, I understand with my whole life insurance plan it has this cash value there, but I don't really want the cash value. I don't want to pay that much more for the cash value. I just want to have a maxed out death benefit. So there's specifically designed plans known as guaranteed universal life plans that essentially eliminate your cash value, have your cash value go as far down to $0 as possible, and then have a guaranteed death benefit rider attached to it to make sure that that plan is still in force. So if you're thinking of it in the terms of term life insurance, it's a type of term life insurance policy out to age 120 or age 115 or 100 or 95, whatever the case may be. So, if you're looking for the max death benefit goal, you have to make sure that's correlating exactly to each dollar that you're placing into this plan. How can you squeeze out the most leverage? If you're looking for now the cash value, the cash surrender value to be maximized, what are there ways on how you can reduce all those costs and make sure that you're shoving as much dollars as possible and you're staying in compliant to make sure that you're getting that tax-free benefits, in the process. So some of the most important things is to understand the problems with cash value when people try to set up cash value maximization plans and they end up doing it the wrong way. The number one mistake that individuals make is they say, okay, well, they focus in on their death benefit need and then think that this is going to be some beautiful hybrid product that's going to give you a really nice death benefit and a really nice cash value, and you could still pull cash value out and still have a death benefit there. And that's when these policies don't work. It's either, if you want to have a maximized death benefit plan, go with the maximized death benefit plan that's going to leverage your dollar to the best amount. If you're going with a maximum cash value plan, make sure that you're stripping away, you're reducing that death benefit as low as possible, you're stripping away those costs as low as possible, so that net amount at risk to the insurance company is very tiny, so that they're not taking that risk and throwing it into those different charges, those different expenses. And that's something that we really pride ourselves on, is we make sure we go through all the top carriers. We make sure based upon what your situation is, we're able to give you hundreds of the top companies, hundreds of the top contracts before we give our top 3 recommendations of saying, yes, this is going to be your best offer, depending upon your area, depending upon your age, depending upon your insurability, etc. So if we understand that little egg shape, that horrible chicken scratch drawing, and we understand that majority of plans are set up where they're placing dollars in and majority of it is going to the cost of insurance because that death benefit is high. Well, we know if we reduce that death benefit, then what it's going to do is have the cost of insurance and the cash value very even. Now, there's a step further that certain carriers came out and they really want to hone in on cash value maximization, where they say, okay, the net amount at risk, even with a regular permanent policy, the company's still on the hook to pay a lump sum death benefit to beneficiaries. So if somebody's going and they have a $500,000 death benefit and they're placing in a couple $100 a month, well, in the first couple of years, that net amount at risk, the risk to the insurance company is so large. So that's why a lot of these plans are front-end loaded plans, meaning that that's why you have the most expensive charges in the first 5 to 10 years of these types of accounts. So even as we're reducing down that death benefit, it has to make sure that you're staying in compliance with something known as a cash value corridor, making sure that you're still maintaining those savings benefits and those tax-free benefits at all times. You can't just go and say, I'm going to throw $100,000 into a policy and then have a $50,000 death benefit. It's something known as a modified endowment contract, which just deems that a regular qualified retirement account, and you lose out on all those tax benefits on the whole reason why you were trying to shove in, all these premium dollars into that cash value maximization. So what we'd have to do is make sure that the amount of dollars that you're looking to place into this plan is set up either on a monthly basis or an annual basis, and you have a certain set duration of time of maybe you're 40 years old and you want to retire at age 65, well, then we calculate how many premium dollars should be going in and what is the smallest amount of death benefit that we could place into that plan. Rather than have this net amount at risk large because this death benefit is going to get paid out as a lump sum, you have specific companies out there that they allow you to annuitize that death benefit out to your beneficiaries to say, okay, rather than a $300,000 death benefit plan that's going to get paid out to the lump sum, which is obviously a very large risk to the insurance company's books, and that insurance company is going to add that additional risk to the costs of your policy, what they could say is, rather than $300,000 as a lump sum, we'll pay your beneficiary $10,000 per year for for the next 30 years. So what that does is it decreases the net amount at risk, and it decreases the amount of charges that you're going to be paying into this plan. So each dollar that you're throwing into the plan is now going to be leveraged that much further of smaller amount of cost of insurance and expenses and larger amount of cash value. So as we're shoving as much cash value into this plan, there's ways on how you could pull out this cash value. And let me clear off the screen. Now, the first way is you could take it out in the form of a withdrawal, which I highly recommend against, because anything above what you placed into that plan, let's say if you threw 100 grand into your life insurance plan, into your cash value plan throughout all these years, throughout 20 years worth of premium payments, and now your cash value is sitting at $500,000. If you try to gank out all that $500,000, you're going to get hit with a huge taxation, the difference at the end of that, at the end of that year, whenever you're pulling out that money. So there's ways that individuals could either take these dollars. You could do something known as a 1035 exchange, throw it into non-qualified annuities, which still is not going to be beneficial, to make sure that you're maximizing out these plans. The most beneficial way to do it is in the form of certain loan values that allow you to take this money out tax-free. So it allows it to grow tax-free, pull this money out tax-free, and then you're able to utilize something known as arbitraging your money, being your own banker, through your insurance policies. And so there's a whole slew of different ways on how individuals could really leverage these types of plans, but you just want to understand what these problems are and how these things get set up. More times than not, I would say about 90% of the time, whenever we deal with a client that got set up in a permanent policy, they really did not understand the benefits of the cash value, and they didn't know how many dollars they were actually placing into these types of plans. They were getting fictitious, illustrations. They were getting, told things that were just incorrect, and they were not leveraging their dollars the proper way. It all comes down to what exactly are your goals? What exactly is a way that you could customize your plan? If you're looking for a high permanent death benefit plan, well, then you might want to look more towards the GUL route. If you're looking for the max cash value plan, well, then you want to make sure that there's certain ways, and you want to go specific with the specific companies that allow you to manipulate that death benefit best way possible. So to make sure for each dollar you're placing in, you're maximizing out that growth. It's not only how much dollars you're netting off in addition to the costs, but then on top of it, what will provide the highest interest rate to that cash value year by year by year, each time that you're placing more and more premium dollars in there. Then also when it comes time to pulling out this money, how could you take it out in the form of loans to make sure that it's coming out in a tax-free manner? And you're staying in compliant with the different internal revenue codes out there. So, there's a whole slew of different ways on how to set this up. One of the things that make us very unique is we're an independent agency, so we're not biased towards one company over the next. All goes by what the client's needs are. So if we represent hundreds of the top carriers, we're not going to keep telling you about company ABC when that might not be the best fit for you. So, it allows us to really work for your benefit and see which are the best routes depending upon what your age is, depending upon what your insurability is, depending upon what dollar amount you're looking to place on an annual basis or a monthly basis. And you could really leverage this for, supplementing your retirement income or for your max death benefit plan. We have a process known as the Retire Sharp planning system that on average each person that calls our office, we go through over 1,200 different product lines, scenarios, strategies before we give our top 3 recommendations. So at any point in time, if you found value in this video, feel free to give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service. You could give us a call mornings, nights, weekends, holidays, whatever the case may be, and we'll have a specialist standing by. You might say, "Hey, I watched the video off of the internet, off of YouTube, and I found some value in this, and I wanted to get some more information." And from there, the specialist is going to ask you a whole slew of questions, seeing exactly whether or not these types of plans can pertain to your goals. Because at the end of the day, if it doesn't pertain to your goals, there's no way in heck that you should be in these types of plans. You want to make sure if you do find it appealing and you do want to leverage it, how can you squeeze out the most amount of leverage from the best carrier that would allow you to do that cash value maximization? And this is one of the reasons we are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. It's because of our methodical process of understanding that education has to be first and foremost, so that everything that you're doing with retirement, you're setting it up the right way, whether that's a death benefit goal or whether that's just a max cash value goal. Everything has to be customized specifically to those goals properly. So at any point in time, if you found value in this, feel free to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. Thank you so much, guys.